Grab Holdings caught the attention of investors last week who pushed the stock up to new highs. However, earnings came out and shares tumbled 10%, taking the stock back below $5 a share. At the latest price, Grab now has a market cap of $20.6 billion US. The company's got $6.1 billion of cash liquidity, some of which is customer deposits, so I estimate net cash at $4.3 billion, giving the company an enterprise value around $16.3 billion. Meanwhile, the company has reported $2.8 billion of revenue over the last 12 months, $313 million of adjusted EBITDA, and $704 million of free cash flow. However, Grab's net income is negative thanks to stock-based compensation, and free cash flow is inflated by Grab's financial segment. Adjust for customer deposits and free cash flow is $136 million. Despite falling 10%, this was a strong quarter for Grab. Delivery revenues increased 13%, mobility revenues increased 19%, and financial service revenues increased 38%. Total group sales were up 17%, and adjusted EBITDA hit a record $97 million. Crucially, the company also delivered solid guidance, forecasting 19 to 22% growth for 2025. If there was an issue with these results, it was a modest decrease in margins. EBITDA margins in the mobility segment dropped back to 8.4%, largely due to an increase in consumer incentives. These incentives are used to entice customers, and they highlight one of the key risks around Grab. Intense competition in Southeast Asia could eventually constrain the company's growth. Meanwhile, investors also need to consider the development of robo-taxis and the possibility of credit losses from customer loans that could affect the financial segment. But despite those risks, Grab's results prove it can grow while cutting expenses, and there's every chance the company can now grow into its valuation. For example, if you assume the company's delivery segment grows at 12% a year for the next 5 years with an adjusted EBITDA margin of 4%, mobility grows at 12% a year with a margin of 8%, and the financial segment grows 20% a year with a margin of 16%, we get to $1.8 billion of EBITDA in 5 years' time, subtract $400 million for regional corporate costs, and EBITDA gets to $1.4 billion. Apply a 25 times multiple, then takes the valuation to $35 billion. Account for cash and stock-based compensation, and the annualized return should work out to just under 16% a year. This number is a very rough estimate, and there are no shortage of things that could go wrong. But Grab also has a large opportunity ahead. There is